Good afternoon. Good afternoon. It's Monday, the 29th of September. Can't believe it's already the end of September as well. 3 more months and we're in December. My name is Thilan Wickramasinghe. I'm the head of research for Maybank Securities here in Singapore. And markets seems to be shaking off the potential for a US government shutdown and seems to be focusing a lot more on interest rate cuts ahead, particularly as the labor market seems to be getting a little bit softer there. And you can see that impact on the Singapore REITs, which are mostly in the green today, and driving the STI higher. But that's not the only thing that's driving the STI higher, or that's not the only thing that could drive the STI higher. Singapore is undergoing a construction boom like what we haven't seen in a long time. We're going to do a deep dive on this with a very interesting note written by Dr. Chua Hak Bin, our co-head of economics research, and he's here to discuss that. And then there's more bad news for Singtel and for Wilmar with a Optus breakdown and Supreme Court in Indonesia overturning a previous decision. What's to make of this? We've got Husseini who's here to explain. Plus, self-driving cars are ready to hit the roads in Singapore. Are they ready for prime time? And what does that mean for some of our transportation companies? Plus, we've got a high conviction call on an offshore and marine company. Plus, we've got some fresh trading buys from our trading guy as well. But let's start with Hak Bin with a brand new report from our macro team on the Singapore's construction boom. Hak Bin, you're forecasting Singapore construction sector to grow at a real annual rate of more than 5% between 2025 and 2030, which is actually much higher than GDP growth. Can you give us some context how this compares to past cycles? When did we last see such high rates of growth?
Hey, hi, morning, Thilan. So I think the last big construction boom was 2004 to 2008. If you recall, Singapore just came out of the tech recession 2001, and then with the SARS 2003, and then Singapore had to make a lot of choices about its policies. And the big decisions then was to open up the casinos, essentially, open up the two integrated resorts, and then pursue a really liberal immigration policy. So I think from that 2004, 2008, you recall that time we had a population boom. Non-residents in particular grew like 200,000 a year, and of course and then of course Singapore's push into the private banking industry. At that time, we wasn't sure how it would turn out, but of course now looking back, it turned out pretty well, with Singapore becoming the Switzerland of Asia. So that really set up a big construction boom. If you go back, that growth in construction was about 8% a year, so pretty strong. You have to go back a bit further if you want to go back beyond the previous episode, and that was in the 1990s, 1995. That was, by my mind, I mean, that time Singapore was growing at rates of 12% of growth. So there were infrastructure spending, there was a pursuit in high-tech manufacturing, semiconductors, and all that Singapore decided to get into, as well as the biotech industry. So that led that boom. But Singapore was a poorer nation then. Of course, there was a lot more building of housing and infra, and of course but those rates were comparable to what Singapore's growth rates were doing. But this time around, it's less about the commercial space. It's more about the big transport hubs, Changi 5, which is 3 times the size of 3 terminals with its own runway. Tuas Megaport, which is if completed, it will be the biggest port in the world. And of course, the HDB housing, there's a bit of backlog catching up from the pandemic. And of course, recently, in the last few months, suddenly the residential land sales have picked up. The number of units sold in August was actually 10 times more than what was sold a year ago, right? And with interest rates remaining pretty low, we expect private sales to be still pretty decent in the coming months. So with all that, there seems to be quite a bit going for the construction sector. Plus, the government has plenty of funds, and they're committed to spend a lot more, especially on climate infrastructure, and also upgrade the whole HDB housing stock, which is aging.
So why is it all happening right now? What's driving this boom, and why the timing?
I don't think it was pre-planned. Part of it you could say like the two casinos, their licenses were up, and they had to commit to new investments to secure that 3-year license renewal, which in Marina Bay Sands secured, but Resorts World only got 2 years, right? So they have to show and expand their offerings to make sure they get tourists in, and as a result, both are spending about 7 billion each. So that's just the licensing cycle. Part of it is the backlog because of the pandemic, and a lot of the HDBs were delayed. So I think there's a bit of catch up in terms of the projects, and of course, the fact that some of the transport hubs, even Changi T5 was actually delayed because of the pandemic. So it's actually had to be accelerated as well, right? So part of it is that, and I think the falling interest rates is helping as well. Falling interest rates has suddenly revived the private residential market. I don't think at the start of the year people were expecting, that many where interest rates are today, right? You can get a mortgage rate of 1.8% or perhaps even below. 2 years ago it's closer to 4 to 5%. So that's starting to revive the residential side. So the only part that hasn't been really woken up is really the commercial land sales. But perhaps with activity picking up, with interest rates remaining so low, maybe interest could return to that sector.
Okay. And how should we think about, I mean, it's all good that you got all this construction spending, but how should we think about that, percolating into the real economy? What sort of multiplier should we think about when we think about construction spending?
So there are government studies from Singstat that shows that the construction sector actually generates the biggest spin-offs, the biggest spillovers to many other sectors. Their own estimates that $1 spent generates about $1.90 roughly to the economy, with benefits to the manufacturing, with financial sector. You can see in the loan growth, for example, now, the loan growth for both the housing loans is picking up, it's over 5% now, but also loans growth to the property development construction sector, which is about 6%. So that's one of the spin-offs. And of course, a lot of the contractors, as the smaller ones, especially that serve HDB, are locally owned, right? Family owned, right? You could say that certain projects on infra the benefit goes to the MNCs, but some of the construction sector, they would feel the benefits of the sales. And concurrent that is that if residential property sales are selling, then a lot of big population of the citizens are actually real estate agents as well, right? They will earn the commission fees and all that. So I think there is it seems to benefit quite a big segment of the population which should, I think, spill over to the economy.
Got it. And in your estimates, how much spending do you think will come through over the next few years?
So when we look at the BCA estimates of what they were looking at for the next few years, it's 39 to 46 billion, which is on the conservative side, because this year they were looking at 47 to 53 billion. But it looks like we're on track to about get 60 billion of construction value contracts this year. Because when you look at the first half, the first 6 months, we're already closing in on 28 billion, which is about 40% higher than last year. So looks pretty good. Looks like the momentum will be sustained. But also fairly comfortable because the construction sector is actually quite a small share of GDP, having been hammered during the pandemic. So it's fallen to about 3.5% of GDP, and even growing at 5%, maybe hopefully closer to 6%, the share will just rise to about 4.2 to 4.5% of GDP. That's well at the peak that the construction sector has been in the past.
Okay, and going by the multiplier that 50-60 billion dollars of construction spending, that's about 100-120 billion roughly of economic impact. Okay, but what can go wrong? What can what might be unexpected here?
Of course, something like the pandemic could kill everybody. We saw that during we saw that during those few years where constructions, many firms went bust. Hopefully it doesn't look like we're gonna hit that. But one big constraint is actually labor. Foreign workers, when we look at the latest numbers, is already roughly for construction, marine shipyard processing is already about 450,000 a year. It's already about 80,000 above pre-pandemic levels, right? So that's already putting a strain on worker dormitories and so on. the demand will still be there. It's just depending whether the government is willing to, accommodate this kind of numbers. And as a result, I think, from what I understand, they even have to basically spread out some of these projects so that otherwise the competition for labor, for the same way, building materials, for the equipment will be pretty high. So the government have to be careful about how they schedule the projects. So maybe some of the reclamation projects along the coastal areas, may can only take place a few years later, for example. So yeah, so they have to manage that. So that's one big constraint. I don't think material prices looks like a big issue right now. There were episodes, when material prices went up to the roof, but now because of the tariff war, trade war, the good news is that stuff like steel and all that, there's actually excess capacity, right? That a lot of the stuff supply, because they're shut off from US markets, is having to be diverted in other markets. And it's so from that point, when you look at the cost of materials, it's actually pretty manageable. It's actually less than 2% inflation wise on those kind of stuff in the first half of the year.
Got it. Thanks, Hagbin. So just following up on what Hagbin said, I mean, when you think about stocks, that can benefit from this construction boom, we actually think, as he said, this can percolate into the overall economy. So I think the banks will benefit, be one of the key beneficiaries from this, from loan demand as well as, from mortgages, but also corporate loans, but also from non-interest income demand as well, as a lot of fees related to loans and stuff start to go up. So I think that's the three banks, DBS, UOB, and OCBC, will benefit, and particularly for some of the smaller developers who are, both UOB and OCBC would have some of the high exposures because they have traditionally had quite a high exposure to those. But apart from that, Sanli Environment, which does some of the water contracts, as well as ISO team, will be also benefiting from a lot of these construction projects, and those are part of our coverage. And been mentioned that property agents will benefit, and PropNex will be a beneficiary of that, and plus some of the developers as well. Hong Kong Land, CityDev, UOL would also benefit from this, from the coverage universe that Maybank has. Now, with that, let's move on to a few moving pieces in the telcos and the internet sector. And let's bring Hussaini here. Hussaini, Optus has had another outage overnight, just as a delegation from Singtel is set to meet the Australian authorities. Why does this keep happening, and what are your initial thoughts on this on Singtel?
Yeah, hi. Thanks, Elan, for having me. And yes, Optus is facing back-to-back outages, and I am getting a fair bit of investor reactions or feedback linked to the same. That reflects a fair bit of concern or anxiety among the investors, in my view. Now, why does this keep happening? It is a bit early to say, but Optus CEO did noted that the 18th September outage was owing to human error. Now, on the last part, means our read through, I think that the stock is likely to remain under pressure or remain range bound given the widespread media coverage as well as the casualties related to 18th September outage. But having said that, the risk or the major risk of a strong or a major share price correction, in my view, is limited. And that is mainly because of two reasons. First is that Optus is around 17% of Singtel's SOTP. So again, the other major businesses like India, Singapore, Indonesia, they are in better shape. Okay, so that kind of cushions the impact. The other factor which cushions the impact is the share buyback program of $2 billion, which Singtel has earlier earmarked. So if there is too much of share price pressure or selling pressure, I think company will come and trigger the share buyback program to kind of cushion the impact of a major share price drop, in my view.
Got it. Yeah. So don't just focus on the bad news. I mean, it is important, but there are quite a few other engines that are operating for Singtel as well. Now, let's stay with the telcos. You actually had a bit of a peek into Simba's latest results as well. How would you read through those results into StarHub and Singtel?
Yes, so Simba reported last week their semester results, and we see some silver linings here. First, Simba is growing, no question about it, but the pace of growth is slowing down. So in the latest quarter, Simba grew around 7% on a half and half basis. In the past, they had been growing at 14 to 25%. So clearly, we see some slowdown in growth. We also see subscriber additions slowing down for Simba, margins stabilizing, which was previously on an improving trend, and in fact, free cash flows in fact declined in the latest semester results. So clearly, we see Simba momentum is slowing down. Now, this slowing momentum suggests that for Simba, growth through market share grabs has run its course. Okay. And with M1 acquisition, M1 will bring its own share of legacy revenues for Simba. And finally, with M1 acquisition, their debt levels will be really high as well. Their net debt to EBITDA will go to almost 4 times, which is very high in our view. So all in all, Simba is slowing down, and with M1 acquisition, they won't they won't be as nimble, or they won't uh, be a newcomer as such, because M1 will bring its own legacy contributions, and this, in our view, bodes positive for the overall competitive landscape in Singapore. So net Singapore had been highly competitive. Competition was very intense for the last 3 4 years, and with Simba slowing down, with this consolidation, we are of the view that things should start to improve from here on.
Got it. So StarHub, Singtel, both should benefit from this. Now, turning attention to the internet sector, we saw Grab launching their self-driving services in Punggol. Can you catch us up on this development? How important is this, and how will this read through to Grab and maybe also to Comfort Delgro?
Yes. So Grab has launched a self-driven or autonomous shuttle bus service in Punggol on 2 routes. It is in partnership with WeRide, a major Chinese player in the autonomous space. Initially, they will deploy 11 vehicles, and for this year, it will be more on a test mode, while passenger services are expected to start from next year. See, autonomous vehicles are evolving fast. So in markets like US and China, commercial robotaxi services are operating, and in fact are scaling really fast. In other parts of the world as well, like Middle East or in Hong Kong, trials are going on as well. We see Singapore as a market which is potentially ready for autonomous ride-hailing services. Its infrastructure, road infrastructure is ready, and LTA remains an enabler. We see Grab as a Grab to benefit from the deployment of autonomous vehicles or ride-hailing services. Now, in our blue sky scenario, assuming 20% of Grab's Singapore fleet transition to AV, this implies a potential annual savings of around 70 million USD, or on an NPV basis, we expect Grab's NPV to go up by 7%. What this factors is that by 2030, given the tech deflation, we expect the per mile autonomous vehicle ride cost to drop to around 52 cents USD, whereas the human driven car, because of inflation, it will go to around 85 USD cents. So given that differential in pricing, we see Grab to benefit on the back of that.
Got it. And now, very quickly, just on Wilmar, they lost their cooking oil case at the Indonesian Supreme Court. What does that mean for the stock?
Yeah, sure. So Wilmar lost the cooking oil case in the Supreme Court, and on the back of that, they have to pay around 11.8 trillion rupiah, or around 700 million USD in penalties. Wilmar has already paid those penalties, or they have already deposited debt in the Attorney General's office in June. So their leverage levels are unlikely to get impacted with that. Their leverage level compared to the June quarter is unlikely to get impacted. However, as they book that in their P&L, their P&L is going to take hit, and likely they are going to slip into losses in the September quarter. Now, from the stock point of view, what it means for the stock, we expect stock to remain under bid pressure or remain range bound on the back of this development. Also to note here is that there are a few more cases going on in Indonesia as well. So that also remains a bit of an overhang on the stock.
Got it. So just watch out on that overhang. Okay, thanks. Thanks, Hussaini, for that. Let's bring our chart guy, Amirul, online. He's got a couple of fresh buy ideas. Amirul, what have you got for us?
All right, thank you, Dylan, for having me. So let me just share my screen first. So before we take a look at our technical trade idea of the day, I just want to quickly highlight on the Straits Times Index first. As what Dylan mentioned earlier, market has been in a pullback phase. However, if you look at the chart over here quickly, we could see that the index now has found support at its 50-day SMA line, which is the same support line that has been served quite crucial back in June of 2025. So this orange line over here serves as a very support line. So if the index breaks below this, that might actually confirm this bullish divergence signs where price index remains in an uptrend. However, momentum remains in the declining mode. That's why it's very important for us to be very careful in our stock picking nowadays. So there are three trading ideas that I want to highlight today. First one will be Banyan Trend Holdings. So price went up by another 0.8% upon our recommendation this morning. So this confirms that this price over here, price structure over here could actually reach above its cup handle pattern over here. Price is now building its handle pattern over here with a strong neckline at 0.640. Given that the price has actually closed above all of its moving average line over here, this means that the bullish momentum has actually regained the upper hand, and we believe if it breaks above this neckline over here, it could actually test our next technical target at 0.665. Support remains at 0.545. And the next one will be NTTDCR REIT. So if you look at the chart over here, the company got listed back in 14th of July 2025, where it actually had a minor pullback from its listing date. However, after its period of sideways range over here, we could see a new renewed bullish momentum has came in, where both the 21-day EMA and the newly formed 50-day SMA line are now sloping upward. This marks a sign that the rounding base pattern over here, you could see this black line over here, could be actually completed soon, where if price breaks above this immediate resistance of 1.02, this could lead to a bullish continuation move and could actually test our target 1.07 with support seen at 0.925. And lastly, before I pass back to Thilen, just a quick one on low Keng Huat Singapore, which I believe is the mover of this morning, as price has rebounded from its 21-day EMA line. And if you could see, since May 2025, it has been acting as a strong support line. And since the rebound has just came with quite a decent volume, we could see that this could also serve as a bullish flag pattern, where if price breaks above the downtrend line, this leads to a bullish continuation move. So for me, low Keng Huat also has a nice chart for investors out there to consider. So that's all for me today. Over back to you, Thilen.
Thanks, Amirul. And that ties in very nicely with our construction theme as well. Now, before I let everyone go, I just want to highlight one key piece of research on Marco Polo Marine that Jorik has put out. What's driving the call? Two major fleet expansion initiatives. First, MPM is collaborating with Norway's Salt Ship Design to build a new commissioning vessel, commissioning service operation vessel, or CSOV. in its Batam shipyard. Construction will start next year and delivery is expected in 2028. Once deployed, the CSOV could add 30 to 35% to the EPS based on current charter rates for similar existing vessels, which are already an existing vessel is already generating about $17.5 million of annual revenue and $5 to $6 million of net profit. Second, MPM is investing $34 million into 2 new anchor handling supply vessels. These will expand the fleet from 19 to 21 by the end of 2026. Each is expected to charter at around $10,000 to $11,000 a day, translating to roughly 3 to 3.5 million of revenue per vessel. On financials, revenues are projected to climb from around 115 million this year to around 161 million in 2027, with EPS growing at a CAGR of around 18% over this period. Balance sheet is strong, so have a look at the stock. Stocks had a bit of a run, but we think this is going to be a key beneficiary of the MAS money as well, and it's lagged some of the other mid-cap peers. So 9 cent target price, buy call on Marco Polo Marine. With that, unfortunately, we are out of time today. Thank you so much for joining us. Have a profitable trading week, and there's a lot more information in our newsletter today, so do have a look at that, and we'll see you next week.